Welcome back to the Allied Wealth on the Money YouTube channel. We're so glad you're here. I've got an interesting topic to talk about today, folks. We're going to be discussing bond values, what bonds are used to do in a portfolio, and how interest rates, because rates are going up right now, impact the value of bonds inside of your portfolio. But first, if you like the channel and the videos that we're doing and putting these out for you, please like our video and also hit the subscribe button down below, and as new stuff comes out, we'll push it out to you. And we do this stuff to provide good education so the folks that watch our show and our channel here can have a real clear understanding of how to position their retirement accounts and how about taxes and when it takes Social Security and long-term probability of success of their plans. All these things we do to bring value to you. So let's dive into the bond conversation and talk about what bonds are generally used for in an overall portfolio. So what you typically have are portfolios that we evaluate on what we call a risk versus return curve. And the way it works is portfolios move out just like this on a curve. So this portfolio here has the highest level of risk and therefore should get the greatest potential return, but it's also going to come with the most up and down movement, if you will. And so the question that we have is, if I have you in that portfolio out there at that high level of risk and you say, Ryan, I'm watching the volatility in my portfolio go up and down, what can we do to reduce the risk and move me back down here to a more conservative portfolio? And the answer is we add bonds to the portfolio. So for instance, this portfolio down here would be mostly bonds. This one's would be all stocks, and then these in the middle would be somewhere in between. So we typically add bonds to a portfolio to reduce volatility and reduce risk. Well, that's an interesting thing an interesting dynamic is occurring with the bond market right now, and it's interesting. So let's unpack it. And here's what I mean. Back in 1980, you could put $1 million into a bond, and you would make about 14% interest. So $1 million in a 10-year treasury would pay you $140,000 a year without taking a dime of risk, guaranteed, backed by the government, same value as your actual cash dollars. Pretty cool, by the way, you know. And so what's happened, though, folks, is if you go and put money into a 10-year treasury today, we're here in 2022, that same $1 million going into that treasury, you might make 2% or $20,000 a year. So why am I showing you this as part of the reducing risk conversation up here? Well, the reason why I'm showing you this is that from 1980 to 2022, rates on bonds have fallen dramatically. Well, that's important to understand because bond values, we'll put BV for bond values, and interest rates have an inverse relationship. So as rates go down, bond values go up. And as rates go up, bond values go down. And folks at home are like, well, Ryan, I don't understand that relationship. Can you unpack that a little bit for me? And let me explain it to you like this. So let's talk about, we had Exxon here near our corporate office. Exxon built a big campus, beautiful place, by the way. And let's just say that to build this campus, Exxon wanted to borrow money from the general public. And the way they would do that is they would issue bonds and basically borrow money from the general public. And here's kind of the way that would work. You would put $1,000 into this bond, and maybe the bond has a 10-year term, and it has a 5% interest rate. What that means is when you buy that bond, you basically loaned Exxon your $1,000 for a period of 10 years. And in return, Exxon is going to pay you 5% per year on your money. So if you hold that bond for 10 years, you will have gotten all of your interest payments and you'll get your $1,000 back. Pretty good deal, right? Well, what happens though, folks, is as interest rates rise, and let's say they go up to 7%, and so a 10-year bond issued by Exxon now is for $1,000 for 10 years is now a 7% interest rate. Well, you say to me, hey, Ryan, I'm no dummy. I mean, look, man, get me out of that bond paying 5%, sell that thing or get me out of it, and let's move my money into the bond paying 7%, right? Because obviously 7% is more interest than 5%. Well, what happens here, folks, is because the rates went up in value, or went up in percentage, this bond right here, the value is going to fall. And what I mean by that is the value is less today. And the way to understand it is, what investor in their right mind would give you $1,000 for that bond paying 5%, well, they can go out and buy a brand new bond for $1,000 paying 7%. So what's going to happen here is this bond value is going to fall, and this is an arbitrary number, folks. Maybe it's worth $800, all right? Well, yes, the bond is worth less money now, but you still have a contractual obligation or contractual agreement with the person you bought the bond from or loaned your money to, in this case, Exxon. So what that means is yes, even though the interim value is down, the Exxon still has to pay you your interest over 10 years of 5% per year, and they have to give you your money back at the end of the 10-year term. So if you sell the bond today, you're going to lose money. But if you hold the bond till its maturity, you're not going to lose any money at all. You'll get your money back and we've gotten all of your interest payments. So it's important to understand how this can impact your overall portfolio. And what happens here is a lot of portfolios that we evaluate through our portfolio x-ray, and if you want to take advantage of that, it's super easy to do. Just give us a call at the office, 281-444-7555. But in order to do that, what we want to do is look at your portfolio, look at the insides of it. And oftentimes what we see is that bond funds are being used inside of a portfolio to reduce risk and up and down volatility. Well, what happens in a bond fund is if rates rise, the underlying value of your bonds goes down and your fund goes down in value. So does it make sense, folks, that if rates have gone down from 14% to 2%, and now we're seeing rates go up, and the Fed has raised rates recently, and there's talk that they're going to expand and accelerate the raising of rates here to combat the runaway inflation that we're currently seeing. Does it make sense to keep reducing risk in our overall portfolio utilizing bonds? Because again, as interest rates go up, bond values fall. So there are alternatives out there today that we should seek and look at that are bond replacement strategies, all right? And so a bond replacement strategy is a vehicle that has the same safety as a bond. It has a term on it, and it provides an interest rate of somewhere between 4, maybe 5, maybe 6% interest, and we actually can use those instruments to replace the bond positions in your portfolio. And what that will do is that will help mitigate the downside risk in your portfolio and kind of smooth out the volatility, if you will. But more importantly, it will keep you from losing money in your safe portfolio, or the portfolio that's, the portion of your portfolio that's designed to have less risk, which in this case bonds. It will keep you from losing money as rates rise, because we know interest rates are going to go up here in the future. It's happening now, and we expect it to happen more. So folks, there's great alternatives out there. I invite you to explore what those are. Give us a call at the office, 281-444-7555. Happy to walk through those strategies with you. Thanks so much for watching the video. Give us a like and subscribe, and we'll keep pushing great content out to you. I'm Ryan Wheless, founder of Allied Wealth, and this is Allied Wealth TV and On the Money.